Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:53 a.m. Central Time, and I'm recording this in preparation for the market day of September the 14th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive on into the overnight on our morning report. In Sunday night, pretty quiet this time. All four broad market indices are up, but they're between scratch and 0.25%. Nothing really to note there. That's of course, at the time of this cut. Crude oil also scratched just a tad down, as is the euro a tad down. The bonds essentially scratched to a tad up, as is gold, the same thing. So none of these, and we're looking at 8 different futures markets, none of them are more than 0.25% from even on Friday's close. Now, on overseas action, a little bit more action. China down 2.65%, Hong Kong up 0.25%, Japan down 1.6%, Germany up about 1/3%, as is the United Kingdom. In terms of macroeconomic reports for today, in the United States, there is nothing really of note. For tomorrow, we have core retail sales, Empire State Manufacturing Index, capacity utilization rate, industrial production. That's about it. The main news event of the week, of course, is, and you've heard this very, very tired saying, is that this Fed announcement's the most important one of the year. Well, that may actually be true finally this time, in that the market is totally coiled up and waiting on this one. And we look at the S&P 500. We have a very definitive kind of coiling pattern going on here, and the best guess, and I've listened to a number of other commentators coming into this morning, everybody kind of figures that we'll likely be relatively sideways, perhaps a little bit of volatility as nervous traders take positions or avoid positions coming into the announcement, which will be about 1 o'clock Central Time on Thursday. And obviously, it's very difficult to take new positions in front of that. We're very likely not to have any follow-through to speak of between now and Thursday, so you're taking a lot of risk with your capital with not a very good probability of reward on that, because we're not likely to move very far. Whether you're trading indexes or individual stocks, obviously there are exceptions, and if you're a very short intraday trader or those kinds of things, that might be something else. But in terms of portfolio traders, in terms of swing traders on an intermediate term time frame, your pot odds for trading in the next 4 days is pretty small. So just kind of keep that in mind. Stay very conservative would be probably the best way to go until you actually have that announcement out. This is much like a national earnings announcement, as it were, in that you will likely have a binary event after the announcement, and that binary event could very well run some stops on the, in quotes, wrong side, and then take off to the other side. But bottom line, until you actually have that, and then you get the noise to settle down and a clear outcome to that announcement, it's going to be very difficult to really get any kind of achievement. You hear the Russell and the NASDAQ. NASDAQ, of course, has been more bullish, and this is really more of a ascending triangle with the flat top, and then, of course, the coil bottom coming together. If we were to break out to the long side, NASDAQ would likely be stronger than the S&P, which is of great note. Most of the time when we look for growth, we look for the NASDAQ to be a leader over the S&P, though we also look for growth from the Russell, and the Russell is decidedly the weakest. And so that's something also to keep in mind. If you draw fib extensions, retracements, I should say, on this very high to this very low, you'll see that the Russell has come back the least, whereas the NASDAQ came back the most. It's actually come back to the 618 retracement, whereas NASDAQ's not even come back to, the Russell has not even come back to the 50. And then the Dow's actually very much like the S&P, as is typical. You usually get Dow and S&P very, very similar, and then the Russell and NASDAQ often kind of march together. You do have, in this case, the Dow and the S&P together, but do not have the NASDAQ and the Russell together. Russell decidedly weaker than the NASDAQ. So just a couple quick comments from the charts there. In terms of our current market conditions, will likely remain somewhat choppy but directionless for the next few days. Closing trend you see 0.84 skew now down below that 125 level and well down from the 135 level that we had a few days ago. So no real signals coming from there. We have on the short-term VIX a 23.43, so that's still, elevated from what we consider normal range, which would be, perhaps about a 20 or below, but certainly nowhere near what it was in recent weeks. Same thing on the standard deviation moves. No standard deviation moves were put in on Thursday or Friday. Things are definitely quieting down. And you notice that the 2 and 3 standard deviation moves have now just about all aged off, though there are still a significant number of 1 standard deviation moves within the last 2 weeks. This is clearly still elevated, and we'll likely have some more volatility coming once we get to the Thursday afternoon Fed announcement. But these are starting to subside, at least in the short term. In terms of the regular daily report, we still continue to see a lot of negatives, though there are some improvements coming into play. The IBD status still remains uptrend under pressure. Accumulation distribution on the S&P chart is a D, NASDAQ an E, so very, very poor patterns there. Very few leading companies. Breadth is very, very narrow. GMI index remains a 0 out of 6 with a sell signal since 8/24, and that author remains largely in cash. RL metric using the primary market condition using moving averages on key levels indicates strong bear condition in the primary time frame. That'd be your core portfolio. And then the stock charts decision point scoreboard, still all a bunch of red arrows. So still, if you put all this together and we look for consensus, the reason we put these different systems together is to look for consensus, and the consensus is decidedly bearish. So if you were to take a 50-50 shot and which way this is likely to go, bearish would be the more likely shot to resolve this pattern, though obviously the Fed's announcement can trump any kind of prior pattern. In terms of position sizing opinion, you do have a little bit of divergence here. The investor size position sizing opinion is calling for a actually that should be 50%. I'll have to change that. And then the volatility based on the VIX is currently at 50 to 75%, so a little bit more based on volatility. In terms of the market posture in the intermediate term, very weak bull. And the S&P's at a 33.2, Dow's at 39.5, NASDAQ the most bullish, as we indicated from the charts and the fib retracement, 54.6, Russell decidedly weaker compared to the NASDAQ at a 34.3. though it's pretty much in line with the S&P. Hedge warning status remains at a level 2, which is our red light, and given the current Fed announcement conditions, we would certainly concur that initiating new positions at this point, is pretty tough. Now, what this really speaks to is not an opinion of entry. It really speaks to what is the level of risk in the market. And when you give these kinds of parameters that we have up here in our portfolio investor posture metrics, the risk is clearly elevated still, though there have been a number of things that have started to resolve. And you see on the volatility base metrics, things have gone to pretty much zero, normal settings, except for the elevated VIX. The VIX is still above an 18, so you've got one warning sign there. You have another warning sign in terms of, well, really, that's, we'd have to say that's really the primary risk metric based on the smaller individual metrics, is just a high VIX at this time. The risk aversion indicators are all actually risk on. So that's one of the reasons why we came down from a 3 to a 2, is that many of these lower metrics have resolved, though the larger, bigger picture still remains largely quite weak indeed. In terms of special opinions, we had some changes here over the weekend. Option income strategies, VIX is still outside the acceptable window, so for novice traders, probably not the easiest time to be trading, even without the Fed announcement. You have the chance, or probabilities are increased for Vega and Delta, really giving your option income strategy quite a ride during the time of that setup. So that's something to kind of keep in mind. Now, more aggressive traders may start wanting to nibble, consider to reduce position size, these kinds of things, especially after Thursday. Once you get some indication as to what the market's likely to do, you might want to start nibbling there. That the thing is that an option income strategy is all about being passive and earning money off of decaying premium with theta, and that theta could get just absolutely obliterated in a hurry by the action that comes in on Thursday. So not a good time to step in front of that Mack truck. In terms of covered call strategies and put selling, we've had some changes here in recognition that many of the individual metrics have started to resolve. Conditions are acceptable to initiate new positions for novice traders with an equal number of in-the-money and out-of-the-money strikes. Consider reduced position size and legging into covered calls through put selling, and then keep your position size in the scale you are willing to own. Super important. Should you decide to nibble on something prior to Thursday, that would be very important. Even better, though, that you wait till after Thursday and get some indication as to what direction the market's likely to go, and then start taking these kinds of positions. These kinds of positions are meant to be, longer held positions, and really, if the market were to totally break down with the Fed announcement being a negative announcement from the market's perspective, your covered call strategy would just get obliterated, and you'd have to be truly willing to own that position for some time until that situation stabilizes. Put selling, much the same thing, and this is perhaps the more conservative thing than the covered calls. This allows you to have some value, as it were, that the market could actually go down before you would be assigned. So if you really like the position and you want to leg into your covered call, this perhaps would be the better way to go. Sell those puts in the position size you're willing to own, and then should that happen, then convert that into a covered call strategy. So the other piece of this is, if you decide on your most interesting stocks to leg in, consider reduced position size. Also consider defined risk position, so spread it off, not just a naked put, but buy some cheaper long put to make that a defined risk position. And when you put all those things together, it's probably starting to be, in the total context, okay to start nibbling at some of these positions. In terms of relative rotation graph that came out on Friday, I have to say this may be one of the negatives on today's report. This is perhaps one of the most negative looking relative rotation graphs I have seen since I started following that metric. There is nothing in that upper right box, and even in terms of coming into the upper left box, not very much there either. Really only Amex Composite is the only thing that would show up in the above the horizontal line. So this is pretty much a warning sign in terms of overall market, I would put it. In terms of sector specific, you do have transportation was actually up on 2 time frames, and a number of these went neutral with Friday's action. But again, we've been in such poor postures on many of these that one big down day, which may not occur again until Thursday if it were to go that direction after the Fed announcement. These would all be quickly all red once again. So bias is still decidedly to the downside. It's much easier for these things to break down than it is for them to break up until new information comes into hand. In terms of percent change, obviously Monday was Friday was an okay day. We had most of the sectors, with the exception of materials and energy, and materials was essentially scratch, though energy was decidedly weak. Most of the other sectors were reasonably positive, though keep in mind the context: the 5-day, 1 month, 3 month, year to date, again, very decidedly bearish. So that's probably enough for today. As always, if you find what you are getting from us is helpful to your trading, we greatly appreciate you retweeting us to your Twitter followers, your StockTwit followers. Like us on YouTube, subscribe to us on the YouTube channel. You'll get announcements of when things are posted if you do that. And then also, of course, feedback can come directly to our email address at support@falconglobaltraders.com. More information about what we do, if you go to this address right here, there's a short video. It talks about some of the things that we do, and you see a little bit of a description here, how we actually apply these principles to our trading. Disclaimers, as always, hit the pause button if you need more time to review these disclaimers. And we look forward to seeing you back here tomorrow morning before the market open for the market preview from Falcon Global. Good trading, everybody.